Welcome to another edition of Retirement Today. I'm your co-host, Jonathan Berkland. With me here in the studio is Michael Reese. He's a certified financial planning professional. He's been doing this for over 25 years now, helping families get to and through retirement with confidence. Mike, how's it going?
I'm doing fantastic.
Yeah.
We're joined here, don't forget, in the studio today.
I really should introduce him, shouldn't I?
Yes, by Benny the IRS tax monster.
I'm sorry, Benny. Yes, he's just sitting delightfully between us, eyes aglow. You should really, if you're listening on the radio and you haven't checked out the YouTube edition of this show, you should do it. It's really going to benefit your eyes and checking out this lovely beast that sits between us.
That's right. Who doesn't want to look at Benny?
That's right.
All right, I know we got a great show going this week, right? So,
Yeah,
Jonathan, we are going to talk about this week why even millionaires can run out of money in retirement.
Yeah, you heard that right. That does happen. It can happen.
Yep.
Right?
Why even millionaires can run out of money in retirement. So it's kind of funny because I've been putting together a kind of a white paper on that, and I'll probably be offering that here in the near future for all of our listeners. But as I was doing the research on putting that paper together, I came across this article from JP Private Wealth Management.
That sounds legitimate.
Yeah, I mean, by the way, doesn't that sound hoity-toity?
It does a little bit, yes.
Like, real snooty.
Yeah.
Like, we're JP Private Wealth Management.
The word private, yeah.
Yes. Now, by the way, it could have been Wells Fargo Private Wealth
Sure.
Management. It doesn't matter the company name. The article just happens to come from JP. And here is the title of the article, interestingly enough. It is called Retirement Planning, ? Even multimillionaires can run out of money. And this is pretty interesting because this whole article, Jonathan, talks about, imagine that you are 60 years old and you retire with $30 million.
Okay, that sounds pretty nice. That's a nice setup, I would think.
Do you think, now, Jonathan, I'm just a crazy question I'm going to send your way.
Okay.
Do you think that if you were to retire with $30 million, that you could probably figure out a way to make it last?
Yes, I would feel pretty confident.
Yeah, well, according to JP Private Wealth Management, or whatever the heck their private client, whatever it is, they say no. There's about a 70% chance you're going to run out of money.
70, as in 70?
Yeah, I can't wait to go into this article. It's going to be great. So here's the thing I want you thinking about as you're listening to tonight's show. If you're listening to the show or you're watching us on YouTube, think about yourself. I mean, I'm guessing you probably do not have $30 million. If you do, based on this article, you really should be working with us and not anyone else out there. But planning is so important.
Yeah.
There are a number of factors going on in the world today that make it harder than ever to make your money last in retirement. And some of those articles we'll be talking about that brought up in this article. So here we go. Let's read. Let's do a little story time. So I like how this article starts out with story time. It says, once upon a time.
Oh.
This could be
like a Disney story or something.
Yes, although I'm scared to say Disney. It's probably a copyrighted word and they'll come sue us or something.
Sorry.
Once upon a time, not long ago in the United States, the 4% rule was a reasonable, albeit very general rule of thumb for everyone, including the wealthy. Mm-hmm. You probably could expect to spend around 4% of your assets annually, and you would be unlikely to run out of money, right? That's what it says. Then, new paragraph, no longer.
No.
Dun, dun, dun. No longer. The financial planner who devised the 4% rule has declared it invalid.
Wow.
Due to the lower returns and higher inflation all economists now see on the horizon.
Yeah.
We agree, says the private client department. It's time to toss the 4% rule out the window. By the way, how long have we been saying that on the show here?
Right, exactly.
Takes them a little while to catch up. That's how it goes. Anyway, it's time to toss that rule out the window. Spending that much every year might now lead anyone, yes, even those with great fortunes, to outspend their resources. And that means a burning question remains. How much might we safely spend each year in retirement? Our analysis suggests the new number is likely more around 2 or 3%, which, by the way, it's interesting that that's their analysis. Morningstar said that way back in 2013, which is coming up on 10 years ago now.
Yes.
So congratulations, JP Morgan Private Client Department. Apparently, you are catching up to the rest of the world now. Good job.
You're current with the times. Right?
Well done. Well done. So let's talk about how they get to their odds of running out of money, right? So here we go. I've got this right here. I've got this. Here we are. You can hear my paper in the background.
It's on paper.
I'm very prepared. Here is their analysis. The question, what is the likelihood that a 60-year-old with a $30 million after-tax portfolio, so we're not even talking IRA money here. Wow. IRA money, which every dollar you pull out is taxable. This is just a regular, maybe they sold a business. Mm-hmm. Or, I don't know, maybe they had a ranch in the family for years and they sold it. They got $30 million bucks, right? And what are the odds that they're going to deplete, they have to say deplete their assets based on different spending rates and allocations. Now they show, what if you spend 4% and you put all of your money in fixed income, like bonds, safety? They say the odds that you will run out of money in 30 years between age 60 and 90 are 100%.
100. Wow.
So don't do that.
Don't do that.
Now, what if you invest in a conservative portfolio? And I'm not 100% certain what their definition of conservative portfolio is. But the odds of running out of money are now 93%.
Slightly better, but still pretty likely. Yeah.
What if you invest in a balanced portfolio? Now, balanced portfolio, I know what that is. That's basically, 50-50 stocks, bonds, maybe 10% in either direction. This is the portfolio that William Bengen, who created the 4% rule, recommended. Mm-hmm. What are the odds you have that balanced portfolio? You're following the 4% rule. You start with $30 million. You take out 4% income. What are the odds you're going to run out of money? What do you think it is, Jonathan?
Gosh, based on the previous numbers, it's 70-something?
78%.
78.
So like 80% chance almost you run out of money.
Yeah.
And finally, if you have a growth portfolio, now it's 69%. So what they're saying is you can't be taking 4% income. Mm-hmm. But here's the problem. Apparently, JP Morgan Private Bank doesn't realize that they think you just invest a portfolio, your money in a portfolio, and you just take income. Apparently, they don't know there are other strategies. But anyway, we'll talk about that.
Yeah.
Right? So what they're saying instead is this. They're saying, what you really should take out, Jonathan, is only 2 or 3%.
Mm-hmm. Right. Now,
I did a little math. Let's say you've got $30 million.
Okay.
And you want to take out 2%. What is that? $600,000 a year?
Yeah.
I think I could survive on that.
Yeah, it's a pretty healthy income. Yep.
But here's the deal. At 2% in a balanced portfolio, they say, congratulations, you only have a 3% chance of running out of money. You know what I would do? If I were only going to take out that much money, I'd put all my money at the bank and get like 3%. And then there's a 100% chance that my money will last for 30 years. It's like ridiculous. Yeah. Here's the thing that kills me. At a 3% distribution rate, they say that even a balanced portfolio, you're still got a 29% chance of running out of money.
And we're talking $30 million, right? This is still a $30 million.
Yes. It's like, goodness. Now, but here's the reality. If you're only going to take out 2 or 3% of your money, that means 97 or 98% stays where?
Yeah.
At JP Morgan Private Bank here, or Private Client, whatever it is, right? Who does this really benefit? Does this benefit you, the client? Or does it just mean, hey, this way they keep more money in their control that they get to charge you fees on? Who does this really benefit? Right? I mean,
right.
Here's the reality. I see studies like this. I'm like, all right, number one, I understand what they're doing. They're saying, hey, we don't like where the future is heading. We think you should be more conservative with your assumptions. I agree with that 100%.
Yeah, that seems fair.
I agree 100%. However, they go overboard.
Yeah.
All right, we're coming up against a break. Now, on the other side, I'm going to tell you, here is how you manage your money. So if you may not have 30 million. You might have something less than that. Odds are high that you have something less than that. But if you have something less than that, or even if you have 30 million, I'm going to share with you, here's how you set up your accounts so that you can pull not 2 or 3%, but 4%, maybe even 5%. So real quickly though, if you're out there and you're thinking to yourself, hey, I'm retired, I'm worried about my money. Maybe you're worried about having your money last. Mm-hmm. You're saying, I'm not sure it's going to last. I'm retired, I might need a second opinion. Maybe you're nearing retirement. And you're thinking, you know what? I might need a second opinion on what I'm doing here because retirement planning is different.
Very. Yep.
All you got to do, give us a quick call, set up a quick 15-minute phone call with Jonathan. And we're up against the break, so real fast, what's that number, Jonathan?
Yeah, give us a call. It's 512-886-5850.
That's right. Okay, 512-886-5850. Calls for a second opinion. And don't go anywhere. We'll be right back.